The story that isn't being told is Tesla storage. This battery storage business grew by 220%. Energy storage as a whole and solar grew by 74%. And this is the part of Tesla people just don't really talk about because it's not that sexy. But the battery business is phenomenal and growing well. And it looks like it has about a 20% margin as well. So, this is a great driver of future growth for Tesla, relevant of automotive. And now Tesla is on a run rate of being a $100 billion revenue company. And one can argue that its valuation is justified in here. And for investors, I think, there's not a lot of big cap companies growing revenue by 47%. So it's an impressive result by any means, even though margins are lower.
Tesla is about to solve one of its biggest supply chain issues. And if the automaker is able to achieve this, then it would have potentially solved a large portion of its problems. For EV makers, sometimes the issue is not about demand. In fact, some of these companies struggle with making electric vehicles available even when there is demand, and a major reason for this is the problem of sourcing their raw materials. Tesla has identified this problem and is taking critical steps to solving it. In this video, we'll explore how Tesla has set out to make this happen, and what this could potentially mean for the automaker and its stock. But first, let's hear what analysts are saying.
I would square it up by saying I think margins are going to improve in the back half of the year. And if I'm wrong by a quarter, they're likely improve in 2024. And the reason is that they are ramping production at Austin, their 4680 battery, which has been a drag on margins. We've talked about lithium prices going down. That benefits Tesla more than it benefits Ford and Giga Berlin. And so that's my base case. Agree that facts are the facts. Margins have been down, but I think that they will rally back here, back half of this year into next year. And as far as the margins and the impact, I think this is a critical topic, which is traditional auto is getting smoked right now when it comes to EVs. Ford, they break it out. They lose 40% in their EV division. Polestar, half owned by Volvo, 45%. Tesla makes about 15% operating margin. My case is this. What you just described, Dan, that's going to be the world of traditional auto. I think they're going to continue to have struggles to improve those margins because it's not just about ramping production. They have to redo their factories, rework their labor contracts, redo their software stack, change their distribution network. They have to start to adopt a more nimble, profitable playbook. And so I agree, margins go down, bad for the business. My bet is a year, 2, 5 years from now, we're going to be talking about big traditional auto that is going to be a fraction of the size that they are today. Just look at what's happening with Toyota today. I think it is a tale of what's to come.
As Tesla continues to pave the way for a greener, more electrified future, its stockholders may stand to benefit from the company's pioneering efforts and the long-term potential this move represents. For instance, Tesla will be shaking off its lithium dependency and earning federal tax credits, with its plan to build a new refinery in Robstown, Texas. According to filings, the company plans to invest $375 million to build the facility. Tesla's move to lithium mining is a strategic step that holds tremendous potential for the company and investors, and we're going to delve into the reasons for this in just a moment. Hey guys, welcome back to Tesla Tomorrow. Tesla's quest to accelerate the world's transition to sustainable energy is no secret. One of the crucial elements in this mission is the development of efficient, high-performance batteries to power its EVs and store renewable energy. That's where lithium comes into play. As you may know, lithium is a key component in lithium-ion batteries, the heart and soul of Tesla's cutting-edge tech. These batteries not only represent power for Tesla's electric vehicles, but they also play a crucial role in its energy storage solutions. To secure a stable and reliable supply of its crucial energy resources, Tesla is making a bold move, venturing into lithium mining. By controlling the supply chains and sourcing its own lithium, Tesla aims to reduce costs, ensure a steady supply of batteries, and strengthen its competitive advantage in the electric vehicle market. But why is this move such a big deal for Tesla, and how can it impact Tesla stock? Let's find out. But before we get into it, if you like this type of content, hit the like button, subscribe, and turn on post notifications to keep up to date on everything going on with Tesla. First, by securing a stable supply of lithium for batteries, Tesla can continue to solidify its position as the leading player in the EV sector, while also refining its commitment to sustainability. Tesla's latest lithium facility will make it the only big American car company that will produce its own lithium, and will also make it easier to fulfill the Made in US subsidy requirements for getting billions in tax credits. The refinery will also push Tesla outside its core focus of building automobiles and into the complex area of lithium refining and processing, a step which Musk has said was necessary if the car company wants to meet its ambitious EV sales targets. Now, this is what it means. As demand for EVs surges and Tesla's global market shares continue to grow, the need for lithium will only intensify. Therefore, by mining its own lithium, Tesla will ensure a stable long-term supply to meet its increasing production needs. This forward-thinking approach not only solidifies Tesla's position as a leading EV manufacturer, but it also boosts investor confidence. The demand for lithium is expected to soar in the coming years. By 2030, Benchmark Mineral Intelligence forecasts that lithium demand will reach 2.4 million metric tons of lithium carbonate equivalent, much higher than the forecasted 900,000 MT of demand expected in 2023. Another factor to consider is the potential cost savings. With in-house lithium mining, Tesla can reduce its battery production costs, allowing for more competitive pricing of its vehicles. This competitive pricing strategy can drive its sales volumes much higher, further cementing Tesla's leadership in the electric vehicle market. This is it. Lithium is the key critical mineral in lithium-ion batteries that power the electric vehicle revolution. Today, the US produces just 1% of the world's lithium, with Australia, Chile, and China leading the way. Lithium is valuable in electric vehicle batteries because it's both the lightest metal and the least dense solid element. That means that batteries made with lithium have a high power-to-weight ratio, which is very important when dealing with transportation. Currently, most of the lithium processing and refining is done by Chinese companies, with Elon Musk and others clamoring for lithium refineries, which are a license to print money, especially when lithium prices are sky high like they were last year. In fact, during his last conference call with investors, Elon urged other car companies to go into the refinery business. And by doing so, Tesla doesn't have to do it all on its own. It's important to note that Tesla is moving into lithium mining, and it extends beyond its vehicles. This commitment aligns perfectly with the automaker's overarching goal of achieving a net zero carbon future. By producing its own batteries with responsibly sourced lithium, Tesla can create a more circular and sustainable supply chain. It also strengthens its reputation as an environmental conscientious company, resonating with environmentally conscientious investors and consumers alike. As a result, Tesla's stock may benefit from heightened investor interest and confidence in the company's long-term vision and commitment to environmental responsibility. This year, however, lithium prices dropped dramatically by more than 80% off their peak, easing the profit margin pressure on other EV makers, and making refining a little bit less attractive from a business standpoint. Still, the made-in-US conditions for the new EV federal subsidies in the Inflation Reduction Act may offset the potential drop in lithium refinery margins. There is no doubt that venturing into lithium mining is not without its challenges. In fact, it's a complex process that requires expertise and capital investment. However, given Tesla's track record and technological innovation and bold business moves, it's safe to say it is well equipped to navigate these challenges successfully. Taking a critical look, we find that the percentage of battery raw materials that have to be sourced from the US or its free trade countries increasing every year. Tesla's latest move and its planned refinery upgrades could even allow the automaker to continue profiting from government credits up until the subsidies expire in 2032. Not only will this set Tesla apart in the industry, but it will also be hugely beneficial for the car company. But what do you think? Let us know down below, and let us know what your valuation of Tesla is. And for more content just like this, go ahead and click on your next video on the screen to see more about what Tesla's been up to. See you there.